Welcome back. In this video, we are going to look at the concept of working capital and working capital management. Now, if you go through the various chapters of financial management, you would come across, certain chapters like cost of capital, capital budgeting, capital structure, dividend policy, the time value of money, risk and return, the concept of leverage, financial and operating leverage. Now, all those are various chapters as well as important chapters in financial management. But here we're going to look at working capital management, which forms an integral and important part of financial management. Now, what is working capital and what is working capital management? Now, working capital is nothing but capital that is required on a day to day basis for day to day operations. And so, the type of capital that you require for day to day operations are, for instance, cash or stock or inventory. You need them on a day to day basis for short term. So, working capital management is concerned with the management of the problem of current assets and current liabilities and their interrelationships. Current assets are those assets which are converted into cash within the accounting period or within 1 year as a result of normal business operations. So, like I've mentioned, cash in hand, cash at bank, stock, inventory, bills receivable, your debtors, DEBT or RS, your prepaid expenses, etc. Those are current assets. But you also have current liabilities, which are to be paid in the ordinary course of business, again within a year, out of the current assets or out of the earnings of the company. For example, creditors, bills payable, bank outstanding debt, outstanding expenses, overdraft, sorry, bank OD is bank overdraft, all right, and outstanding expenses or lag in payment of wages and so on. Now, those are all current liabilities. And the gross working capital of a firm is nothing but its total current assets, and the net working capital is nothing but the difference between the current assets and the current liabilities. And always remember, in order to have a working capital in the firm, the current assets have to outweigh the current liabilities. In other words, CA, current assets, have to be greater than CL, current liabilities. And what is the objective of current assets management? Number one is to maintain the optimum level of current assets and reduce the level of current liabilities. Now, that is an ideal situation when you have, much more current assets than current liabilities, or when you have only current assets. But then again, in reality, in the normal course of business, you cannot do away with current liabilities. They are bound to crop up at some point or the other. So therefore, you will have current liabilities, but make sure that the current assets should be greater than the current liabilities, thereby reducing funds locked up in working capital and ensure healthy return on investment. And the second one is to ensure that they have a sufficient current assets to meet the current liabilities. All right. For example, outstanding expenses. From where will you meet the outstanding expenses? From your current assets. Like what? Cash. You need cash to pay off your, say, your wages, your labors, your outstanding expenses. You have to pay off your creditors and so on. So that is the objective of current assets management. Next, let's look at the characteristics of current assets. Number one, it has a short lifespan, and I told you that current assets, are assets that we can be easily converted into cash within a span of 1 year. Okay, and there's a shift transformation from one asset form to another. I'll show you how. For example, cash. You'll need cash. When you have cash, that cash is not gonna remain with you forever or for a long time in that form. Why? Because you're going to use cash to purchase raw materials, and those raw materials will be converted into work in progress, which will eventually be converted to finished goods. And in a ideal situation, those finished goods will be sold off as will be sold off to customers in the form of cash. But then again, in business you cannot avoid giving credit. You have to give credit to your customers, and so when you extend credit to your customers, your customers become your debtors. So from cash, cash will be converted into raw materials will be converted into work in progress will be converted into finished goods, and they'll be converted into debtors, that means accounts receivable. And finally, after a certain period of time, you will collect back the money from your debtors, and thereby you have cash. But then again, cash will not stay like that for a long time because of the operating cycle. We will talk about operating cycle in a very short while. Let's just first look at the classification of working capital. Now, working capital can be classified on the basis of two two aspects. One is on the basis of concept and on the basis of time. Now, on the basis of concept, working capital is classified as gross working capital, which we have seen earlier, that gross working capital is nothing but the total current assets. Again, I repeat, gross working capital is nothing but the total current assets, and net working capital is current assets minus current liabilities. So on the basis of concept, you have gross working capital and net working capital. And then on the basis of time, you have two. You have permanent or fixed working capital, and you have temporary or variable working capital. Let's look at permanent working capital. What is it? Now, it is nothing, like it's mentioned here, it is nothing but the minimum amount which is required to ensure effective utilization of fixed facilities and for maintaining the circulation of current assets. For example, every firm has to maintain a minimum level of raw materials, work in progress or work in process, finished goods, and cash balance. Okay, now this minimum level of current assets is called permanent or fixed working capital. Now, if you don't have cash with you, some minimum cash, you become insolvent. All right, so some level and amount of cash have to be maintained, and that minimum cash that you maintain is a current asset, which is known as fixed working capital or permanent working capital. Same thing applies with stock, with raw materials, with finished goods, and so on. And the permanent working capital or fixed working capital can be further classified as regular working capital and reserve working capital. Regular working capital is required to ensure circulation of current assets from cash to inventories, that means from cash to stock, and from stock to receivables, accounts receivables, and finally from receivables to cash, and so on. Now, so that is the regular working capital. Then you have reserve working capital, which is the excess amount over the requirements for regular working capital, which may be provided for contingencies that may arise at unstated periods such as strikes, rise in prices, depressions, etc. I'll give you a good example here. Let's just say stock of raw material. Now let's say your lead time, okay, the time period between placing an order for those stocks and receiving those stocks is, let's say about 5 days. And let's say you order your stock today, after 5 days you get your stocks. But on a regular normal given circumstances, it takes about 5 days. But you know what, normal times do not prevail the whole time, every time. There are times where there may be a breakdown in the transportation. There may be strikes, there may be road blockades, So you will not be able to receive your stocks on time. And when you don't receive your stocks on time, then automatically your production machinery, your production process suffers. And that is not an ideal situation at all for any business. So what do you do when you don't get your stocks on time? You fall back on something which is known as buffer stock or safety stock. So that safety stock or that buffer stock that you keep with you at all times in case of contingencies, that is known as a reserve working capital. Same thing with cash and so on. And finally, you have temporary or variable working capital. And what is it? It is nothing but that amount of capital which is required to meet the seasonal demands and some special exigencies. Variable working capital can be further classified as seasonal working capital and special working capital. The capital required to meet the seasonal needs of the enterprise is called seasonal working capital. Special working capital is that part of the working capital which is required to meet special exigencies such as launching of extensive marketing campaigns for conducting research, etc. So this kind of working capital, it is known as variable or temporary because you only need them at a certain period of the year. For example, you take a company that manufacture, let's say, ceiling fans. And when do you require ceiling fans? You usually require ceiling fans when the weather is hot. And so during the winter you do not require ceiling fans, but during the summer you'll need a lot of ceiling fans, right? So what do you do? So you'll have to manufacture a good amount of ceiling fans during the summer season. And so manufacturing a good amount or a large amount of ceiling fans during summer season also requires an additional working capital, like cash and stock and so on. And so that is on the basis of a seasonal demand. But you also have temporary working capital where, like it's mentioned here, you need it maybe of when you launch an extensive marketing campaign. Okay, again, you're not going to launch marketing campaigns all the time, right? It's only when you launch you'll require some working capital. So that is known as your special working capital. All right. Now, earlier I said we're going to look at the operating cycle. Now, what is operating cycle? Operating cycle is very important because working capital, like I said, one of the characteristics of working capital is that it transforms from one form to the other. It takes shape from one form or the other. Cash does not remain cash forever. Cash will be turned into raw material. Raw material will be converted into work in progress. Work in progress will be converted into finished goods. Finished goods will be converted to either cash or debtors or receivables, which eventually will be converted again into cash. So there is something which is known as the operating cycle, and the operating cycle begins with the acquisitions of raw materials and ends with the collections of receivables. All right, so you see here, so you have cash, raw material, work in process. So it starts with cash, ends with cash. It starts with you use cash to buy raw materials, or at times you also buy raw materials on credit. So when you buy your raw materials, when you purchase your raw materials on credit, then you have creditors that you need to pay off later. All right, so the operating cycle can be divided into 4 stages. One is the raw material storage period, your work in progress storage period, your finished goods storage period, and your debtors collection period. All right, and the duration of the working capital is equal to the sum of the duration of each of these 4 stages minus the credit period allowed by creditors, or nothing, or the creditors payment period. All right, and the operating cycle is nothing but the raw material storage period plus the work in process storage period plus the finished goods storage period plus debtors collection period minus creditors payment period. Now, so this is so we are done. We are done with the introduction to to working capital management. Uh, stay tuned for the next couple of videos, because I am going to show you how to calculate the operating cycle or the cash cycle, all right, and as well as the working capital requirements. So stay tuned for the next couple of videos.